my dad reading the paper one day, and he was looking at the financial pages, which have a different aspect from the comics or the sports pages. I said, what is that? And he said, well, that's the financial pages. I said, what is it? He said, well, these are companies. And I said, what do those numbers mean? And he said, well, you see that plus 1/4? He said, that means that if you owned that company yesterday, and he said, you can see 10, that's the price. So $10 to own one share of that company. And if you had it, you have 25 cents more today than you had yesterday. And so you made money. And I thought a second, and I said, well, what do you have to do to make it go up like that? And he said, nothing, it does it by itself. And I said, well, this is something I need to know about, because I've been out mowing the grass for 3 hours for 25 cents, and I figure if I can go to sleep and wake up and have the same money, then that's something I need to understand. And so I said, this is what I want to do. I said, you can make money without doing any work. And I only realized a lot later that you can get the market rate of return without doing any work, but actually an excess rate of return does require work. Came to Legg Mason in 1981 after a stint as a treasurer for a steel and company made refractories for the steel and cement industry, and that's where I began actually managing portfolios. We had a portfolio. We also had that we managed internally, and then we hired money managers as well externally. So I got a chance to evaluate money managers and also run some internal money. We're value investors. We always have been, and that's part of the reason I came to Legg Mason. It was one of the very few regional brokerage firms, didn't have a money management division when I got here, that actually had an investment philosophy that was valuation driven. I'd read about Warren Buffett in the Adam Smith book, The Super Investor, Super Money, and was immediately attracted to that style. Read about Ben Graham, read The Intelligent Investor, and that's what I was doing at the company I was with as well, using that kind of an investment style. So that fit naturally, and I agree with Warren that when you explain value investing to somebody, they get it or they don't. And if they don't understand the principles of buying something at a lot less than it's worth, you're not going to convince them of the merits of that approach, because it's psychologically very hard to do. So you're typically going against the crowd. Where we, I think, have parted ways, at least initially, from other value managers, was in our ability to look at technology names. So in the mid-1990s, when the market was under a lot of pressure, we took a look at tech, and we did it because you could look at something like Dell was trading at 5 times earnings with a 25% return on equity. Most value guys were buying steel and paper companies and cement companies at the time. It was unclear to me why, unless these were really shaky businesses, why I wasn't better off doing that, which led us into the study of the economics of technology. And that's, I think, what really, where things really changed for us. We got involved with the Santa Fe Institute out in Santa Fe, which was in a guy named Brian Arthur there, who's focuses on the economics of technology, and he pointed out that the nature of technology is such that that while he agreed with Buffett that technologies change a lot. Intel has new chips every couple of years. IBM or somebody has new computers. That the market shares of technology companies are remarkably stable, and so whereas Buffett marvels correctly at Nike's 47% market share, Coke's 48% market share, Gillette's 65 or 70% market share, Microsoft's market share is 85 or 90%, Intel's 85 or 90%, Cisco's in their addressable market's 85+%. So, and if you think about antitrust actions ever since the Sherman Act, they've all been directed at what were then technology companies. So that led us to understand that you could actually invest in these things if you understood the economics of the business as well, and that's what we started doing in the mid-1990s, and that then led us into the internet companies, which have even more remarkable abilities to earn high returns on capital and even more remarkably stable market shares. So that's been a competitive advantage of ours, I think, since then. Now many other value investors have now followed us into those things. Mason Hawkins just buying a lot of eBay, Chris Davis buying Amazon and Google, and so. But I think it's come about that I think many value investors have understood that these businesses can be analyzed, and they don't change so fast that you can't get your arms around them.